Hey traders, this is Christian from Hertz Tribeca Trade Group with your weekly macro recap and the week ahead video. So a couple things from last week, and I want to go over the newsletter that we put out every Sunday. So first things first, some fireworks on Friday after really a dismal last 3 weeks in terms of market activity. I think we're down about 0.5% in SPY for the last 3 weeks if you average them together. So we really haven't had much of a market movement at all. So let's just do a quick recap of last week's economics, because that's going to lead us into the Jackson Hole meeting. And the economics last week were I think pretty good overall. New home sales, which is a leading indicator, positive there, 654,000 versus 580,000. We also had durable goods very strong, plus 4.4%. If you remember, last month's report was a little bit of a warning or maybe a hiccup. Now that we see this month's report coming out much stronger, so if you average the 2 months together, you could see that they are positive. And capital goods orders very strong. These are all leading indicators, by the way, leading market indicators. And then we had on Friday GDP, which seems to be the troubling spot, up 1.1%. But again, it is a lagging indicator. GDP is a lagging indicator. So I think the other indicators that I mentioned, which are strong, the leading indicators, a little bit more important, I think, than the GDP, considering it's a lagging indicator. Personal consumption strong, plus 4.4%. So why am I going over all these? Just to kind of give an overall view that the economics are, you always have to go with the most recent reports, and I feel the leading indicators, and they're pretty strong, which points us to what happened on Friday with the Jackson Hole meeting. So going into the week, the Fed fund futures, which is a really good gauge of the probability of the rate hike and what the market is implying, or what it's thinking in terms of a rate hike, very low going into the meeting. And we talked about this in the Thursday night webinar. We said that I was not comfortable with this, and the market doesn't like shocks. It also doesn't like uncertainty. So the fact that the September Fed fund futures were only implying about a 26% chance of a Fed rate hike was just too low, in my opinion. And same thing for this December. It was around 45%. This was, again, going into Friday's meeting. So does it make sense that we sold off on Friday? I think it absolutely does. Look at the interest rate. Look at what we're expecting now, 42% and 65%. Also going out to March. Again, this was around 50% just on Thursday. So now it's 71%. So the market is coming to terms with the possibility of a rate hike, one hike maybe coming in 2016. So whether or not this actually happens, whether they actually do what they say they might do, at least the market is becoming is getting used to the idea. And again, that was the reason, I think it made perfect sense to me why we sold off. The original move higher did not make sense to me, but the move lower absolutely did make sense on Friday. So where does this leave us? Well, the VIX is now at 13.65. It was under 12 for a while, which also makes me very uneasy when the VIX is that low. It could basically only go up at that point, and things are too calm. Also, just kind of recap from last week, which I'm going to get into fund flows. Very light fund, very little activity all week long. Where there was about $1 billion that came out of equity ETFs on Friday, but for the week, as I was saying on Twitter, there's nothing going on. There's no money being added. There was also no money really being taken out Monday through Thursday. So really dismal action. There was some sector outflows, healthcare, utilities, not really much going on in terms of inflows. Some dip buying going on in the gold miners, which were down pretty hard last week. International ETFs still inflows into emerging markets, 7 straight weeks, but pretty quiet. 385 million. The week before that was 1.5 billion. So not a big inflow for emerging markets last week. So it's something to keep an eye on there. But why I watch this data is I'm looking to find where people are if people are starting to buy the market again, and where exactly they're allocating money into. So we'll see if that changes this week, now that the Jackson Hole meeting is behind us. For economics this week, there's a jobs report that's coming, so that'll be most important. I believe that's on Friday. So I want to take a look at some technicals now. So first things first, the S&P chart. Go to the weekly chart. A little bit revealing here. So we have not had a break in the value area for a while now. Since Brexit, I've been very positive or very bullish since the Brexit, since this dip buying occurred, and we've been up above the value area. This was in July, pretty much the whole month. Nice, powerful move here, and then we've remained above value. We got into value in the beginning of the month in August, but then went right above. So we've been pretty much hanging above this value area for the last couple of weeks, but we're starting to see a little bit of a crack here. So, we'll see if we get some continuation. I think we might have a little bit of volatility in the beginning of the week. And what I'm looking for is we only have a couple more days left in August. I want to see if the S&P is going to open up below this developing value area. That will be a bearish sign. So right now, I'd have to say, I've turned a little bit. I've been bullish for the last couple months, but I'm starting to get a little bit more bearish to neutral to bearish right now. We'll see. What will really kind of hammer the nail for me in terms of being more bearish is if we open it up below that value area. However, so that being said, we're still in a buyer's market. We're still seeing sector rotate. We're still in a stock pickers market, and we're still seeing various sector rotations, which I think you can be long some sectors and you can be short some sectors. So I want to go over that. First things first, I want to go over bonds. That was the other big move on Friday. There was a lot of big moves on Friday, but I think this is revealing. We talked about this in last week's video. I was leaning bearish bonds, and we sure enough in the long bond. This is /ZB. This is the 30-year Treasury bond futures. We broke below volume, and we broke below value, and we did that on heavy volume, just like we did in the S&P, which I don't have that here. But if you look at SPYs, break below volume with greater than normal volume. So we could look at TLT, which is 20-year, but you could see the volume tick up here. So we're below value. What I would look for is a target to 168.18. That's in the 30-year bond futures. That is a virgin point of control, or VPOC. We use these as targets. Sometimes they act as magnets. So that's what I see in the bonds. And why this is, why I'm talking about bonds here is because it has a lot of implications. So first things first, we did see a call buyer in the banking ETF. That's KBE, a little bit different than KRE. KRE is regional banks. KBE is all banks. So not only the regional banks, but also the money center banks, the Bank of America, JP Morgan, Morgan Stanley, that type of thing. And this looks pretty positive to me. Looking on the weekly chart, we've pushed into the yearly value area. So this value area remains constant all year. It's usually a pretty good positive, pretty nice positive once we get into value and stay in there. So I'm going to be long banks. I'm looking for a swing trade. Again, we did see a December call option go up in KBE. I like that trade. So what I'm looking for is, as long as banks stay above 33.06, I think you can be long them. And then on the flip side, so that's a swing trade that I'm looking to do on Monday. I don't have a position on the banks, but that's what I'm looking at. So we started to see, even before bonds broke down, if you go to the telecom ETF, you go to the daily chart, this was a trade that we took a couple weeks ago. I'm out of that once I hit my target, but you could see this break of value, and way down did we go. So we also see the same type of thing going on in the other higher dividend yielding plays, equity yielding plays, high div yielding plays. You see this in utilities. Utility, big red bar on Friday, down 2%. But this is where we broke value here, and we've been continuing to go lower here. So that's one of the trades that I initiated last week was REITs. Take a look at what REITs are doing. Here was your first sell signal, then break below value, which we started to go down towards the middle of last week. And you could see we kind of reached a low point here. And take a look at the volume as we've gone lower here. Volume confirming that that maybe there's a new trend going on here. So I took one target so far in that IYR short trade. I've got puts on in IYR. What I'm looking for is a move down to 79.16. So I'll remain short that trade until we get down to this target. So what else am I looking at this week? Let me just bring you up to date with the newsletter. We talked about banks. We talked about REITs. I want to talk about healthcare. That was definitely in the spotlight last week. So two things that are revealing here in biotech. This was after the EpiPen drama with Mylan last week. We started off the week very positive biotech. I'm looking at XBI. The reason why I'm looking at XBI and not IBB, I prefer XBI because it not only has the large caps, which are heavy in the IBB, your Gilead, your Biogen, your Amgen, your Celgene. Those names are a large weight in the IBB, and they are also in the XBI ETF, but XBI also has a lot of your smaller cap biotechs in there. So a good representation of the whole sector. So we almost got into that value area, just like we were talking with the banks, but we rejected it. So this is the thing that you want to be careful. You want to make sure that you're firmly in the value area before you take a long position. And you can see that we got in there, but we rejected it. So resistance right now will stand at 64.07 in XBI. And to go long for a swing trade, I really want to be above that level as confirmation. So that's the resistance. And then we have support. If you go down to the daily chart in XBI, this was the big decline on Wednesday, followed by a further decline. And look at where we found support right at the top of value. So we held the value area, which is a positive sign, but we're still kind of caught in the middle right here. We're below this moving average went below. This is the 5. The yellow is the 5, the blue is the 20. So going below a crossover to the downside is bearish. So we want to get back above this, I would say this candle here and possibly this one to be bullish. On the downside, what you want to be careful of is a breach of this, what is it, 59.10, call it. If we go below 59.10, that is a further confirmation bearish sign for biotech. Also, like I said, with S&P, we're coming across to the beginning of September, and we've got a new value area here. If we start the month below value, a bearish sign there, and we've got a VPOC down here, but we also have a VPOC up here. So I think you have to kind of be patient with this and kind of let this play out. Either if it goes lower, you can go short biotech, or if it gets back above that level that I mentioned on the weekly chart, which is 64.07, then you can be bullish. So too early to tell right now, and we'll see if the EpiPen resurfaces itself again next week, there was full coverage of that on CNBC. And then finally, I talked about banks. Take a look at Insurers. Take a look at the chart of the Insurers breaking out to new all-time highs here. That's the KIE ETF. You could play this ETF in cash, but in terms of options, it's very liquid. So what you might want to look at instead is, we highlighted in the newsletter, a couple different names here to take a look at. Pru, obviously, Pru, Met, and Berkshire, other names that are in this ETF. Maybe look for unusual. I'm looking for unusual option activity to kind of get me into some of these names. But PFG, Principal Financial, Genworth, GNW, Lincoln National, LNC, AIG, which had really strong earnings. I've been in a swing trade in this name. I'm no longer in it, but I can always look to re-enter that name. But very positive looking chart. So I'll leave it there. You can, if you like these videos and if you're looking to get it involved in our swing trade program and to look at our newsletter, which I'm not covering single names that we're watching, but we do have those in the newsletter as well. So to get involved in our swing trade program, you can go right to tribecatradegroup.com, go to our product section, and you can sign up here. If you're more of an active trader and you're looking for a live trading room, you can get involved in our senior trading desk package, and you get a free week for that. I want people to come in and try it for a week. Once you kind of give it a look, I think you're really going to like it. That's why I give a week free. So there you go. Thank you for watching the video, and have a great weekend. Thanks.